You're watching Beyond Markets and welcome. I'm Kenneth Igbomor. On today's show, we'll continue our conversation on the IMF's regional outlook for sub-Saharan Africa. You can join the conversation with the hashtag Beyond Markets, and you can also follow me on my handle at Kenneth Igbomor. Now, the International Monetary Fund says it expects aggregate growth for sub-Saharan Africa to pick up from 3% in 2018 to 3.5% in 2019 and stabilize at slightly below 4% over the medium term. I have with me Abebe Selassie, the Director of the IMF Africa Department, and Bismarck Rewane, CEO of Financial Derivatives, and as well Andrew Nevin, the Chief Economist at PwC. They're joining me and we'll continue our discussion that we started earlier on the outlook for the continent.
There are exciting things happening in the banking sector. Of course, in East Africa, increasingly in West Africa also, of course, you have fintech making a big change. Frankly, I think the degree to which it has promoted financial inclusion is really just something that we should savor. It really has been fantastic. It has allowed more women to have access to bank accounts, people in the rural area to have access to bank accounts. So I think it's revolutionizing how people save money, and I think it's something to be watched closely. And wherever that's not taking place, I think countries are falling behind and reforms are needed to facilitate that. So that's one exciting innovation. But we shouldn't also underestimate how important it is for regular banks to continue to be the main intermediaries. And there, at least from the policy side, which is what we focus on, what's important is for central banks, supervisory authorities to continue to make sure that banks are adequately capitalized, supervised very effectively and regulated fairly closely, because spillovers from banks that are not regulated well can be quite harmful. We're talking with Andrew earlier about the European Euro area experience, countries that were impacted by the crisis from poor banking practices. So the last thing our economies need is that kind of crisis emanating from the banking sector, because it can be costly. We don't see the risk of that across the board, but there are some places where bank capitalization is an issue.
But what would you say has been the monetary policy response to the banking sector?
The policy response, but by and large, we've seen good initiatives in recent years to try and clean up banking sector. I think a good recent example is in Ghana, where the government has made a very concerted effort to try and identify banks which don't have adequate capital, requiring them to inject more capital. So I think that kind of initiative needs to be taken. The key thing about banking is a little like farming and weeding. You have to be at it. Supervision and regulation is something that is a continuous thing. You cannot rest on your laurels. So you have to keep monitoring the activities of banks, trying to make sure that they remain on a sound footing.
All right, then let me bring in Bismarck on this as well. Can you speak to the banking sector in there? And I'm also very curious about the non-performing loans.
Yeah, of course. There is a correlation between non-performing loans and the business cycle. So here we are, in Nigeria in particular, we got out of a recession. There's been a slowdown across in Africa. So the banking systems are challenged because they are the ones that provide the finance. But more important is that the payment system and the banking system, an efficient payment system eats into the profitability of the banks because of the fintech disruption. And with that erosion in their profitability, they need to do other things. And now the banks now have to focus on the SME space, which they've avoided in the past. So all they've done, in most cases across, is that they've taken deposits and funded the government. Now they're going to have to take deposits and fund the small and medium scale, the bottom of the pyramid, with using technology to make that more efficient for risk management purposes. But also the fact that the payment system, because Abebe was talking about bank accounts, the bank account is one thing, but the mobile wallet is another. Now, if that, we've seen in Ivory Coast, in Ghana, and in Kenya, if you now have the mobile wallet in big, highly populated markets like Nigeria, then aggregate consumption and the velocity of circulation of money becomes impacted. But also important is that because of the informal sector and regional trade, the whole idea of having currency values determined by the central banks and rather than the markets, we are going into a territory which I am not so sure that the policymakers in these African countries are ready for that type of volatility, one, and the adjustments that need to be made when you kick in these things. Because if I'm making a payment with my mobile wallet and I meet you in the streets of Accra and I say, okay, you give me this, and all of a sudden we're having capital account convertibility before current account convertibility. Normally you have current account convertibility before countries go into capital account, but you may begin to see flows of investments at exchange rates that are not determined by the government. So I just want us to understand that there's an advantage, there will be output, but the policymakers and the policy risks are relatively high in this environment.
Okay, Andrew, I'd like to get your comment on this, and I'd also like to comment as we add the comment on around diaspora remittances and how that could also help, the continent.
Well, let me start on the banking sector. I think the Ghana example illustrates something very important, is that there's too many banks that are subscale in Africa. When you think of where banking is going, you've got digital transformation, you have big issues around AML, KYC, IFRS 9, cybersecurity. Only a big bank has the resources and the capital adequacy to be able to deal with those issues. So I think the issues that we've seen in Ghana with a number of banking failures is because small banks can't do that. So I would like to see the emergence more of these Pan-African banks that can also support Pan-African trade. So obviously the leader in this is EcoBank. We also have UBA is made to Access, Standard Bank in South Africa. And we need those big, strong banks. And then, of course, the Francophone banks are also, I think, there are a number of big, strong ones. So that's the issue for me. And I think that the national central bank should really discourage or encourage a consolidation at their level, because these small banks that can't make the transition, I don't think are necessarily helping the economy of Africa, and particularly as we move, and we'll talk about AFCFTA, being able to support regional integration. In terms of the remittances, I think that one thing that we're certainly talking about in Nigeria is we haven't paid enough attention to the fact that the biggest flow is actually our diaspora. So the amount of money coming into the country from the diaspora is more than from oil. If you look at it, and of course the official remittances don't reflect it, because there's also big unofficial remittances. So certainly, and that's true in many other countries. I think in Liberia 25% of the GDP is from Ghana. It's actually larger than Nigeria, and that doesn't even capture, I think there's a huge amount of intra-Africa remittances. So you think of South Africa to Zimbabwe, you think of Nigeria to Benin, there's large amounts of that normally going in an unofficial channel. So I think one strategy for the continent is we're exporting people. How do we take advantage of that? We've got, certainly in Nigeria, a very successful diaspora. They earn more than the average American when Nigerian Americans. What's the strategy behind maximizing the value of that?
All right, then. Abebe, I'd like to take to another segment of this conversation, and we're going to look at human capital investment. When you're looking at your projections you're giving for the continent, and you look at how much needs to be done, to accelerate human capital investment in the health and education especially, how do you think we're weighing up onto this?
So, this is an area where we cannot afford to fail as a region. And this is really one of the common policy challenges that the region faces, and one which is common across the region. So there's a couple of things. First is the demographic trends unfolding in the region. By 2030, 2035 at the latest, half of the working age population in the world, half of the increase in the working age population will come from sub-Saharan Africa. So that's a huge, large number of young people that are coming into the workforce. If we don't educate these kids, if we don't provide high quality education, they will not be ready for the jobs in the future, nor will they be able to participate in and contribute to the global economy. So investing in education, and importantly, of course, health, between now and as in our young people now, is really, really of paramount importance for laying the foundations for future prosperity in our countries.
All right, and Bismarck, I'd like to chip in on this one as well, because I also remember when Bill Gates came to Nigeria the other time, he harped on the importance of human capital investment. We are home to one of the highest number of out-of-school children in there, and when you look at how things are playing out, how do you think we can respond to some of this?
I think the investment in education, because the classrooms of today are the factories of tomorrow. And it's not just the amount of invested, but the quality of the investment. the thing about education in Nigeria in particular, it's both a federal issue and a state issue. There's also a misdiagnosis of the problem. We keep on talking about university education and all that, which is not functional, not really to the job requirements. So the whole idea of vocational education, the whole idea of ensuring that there's activities that have an impact, right? Because what we are seeing is that we are having growth in sectors which are not that job elastic. In other words, if you grow more refineries, they're not going to employ, or telcos. You need that bottom of the pyramid approach where people can be employed. Gender inclusivity in terms of schools. When you look at the persistence ratio in education, I was talking to the state governors yesterday and that there was need, and this, I think this cuts across the whole of Africa, to actually begin to invest in gender inclusivity, education at the primary school level, and vocational education, rather than having 400 universities producing dysfunctional graduates.
All right, Andrew, your thoughts?
Well, I agree with Bismarck. Certainly in this country, we need more focus on vocational things that drive job creation. But I also think with respect to education and health as well, we need to be embracing some innovation. I don't think it's actually mathematically possible to deliver education in the traditional way on the scale that's required across Africa. So, you know, we need some of these ed tech type of innovations. We need these kind of health tech innovations. Not necessarily that we're removing the human element, but I mean, if we can't necessarily train to a doctor level enough people in this country or be in all the rural areas, so you need to then support them with innovation. So I think one thing the IMF could certainly lend its voice to is what role does innovation play in some of these areas in Africa to drive our development?
I've been speaking to Abebe Selassie, the Director for IMF's Africa Department, and Bismarck Rewane, CEO of Financial Derivatives, and Andrew Nevin, the Chief Economist at PwC Nigeria. We'll continue our conversation after the break. If you're just joining us, Abebe Selassie, the Director of the IMF African Department, Bismarck Rewane, and CEO of Financial Derivatives, and Andrew Nevin, the Chief Economist at PwC Nigeria, are with me today, and we're discussing the IMF's regional outlook for sub-Saharan Africa.
So thank you for drawing attention to this. Indeed, one of the chapters in our report is focused on the toll that conflict is exacting on many countries in the region. So one of the big trend in the region, of course, has been that relative to the 1990s, even 80s, the level of conflict-related deaths in the region are much lower. I mean, it bottomed out at around 2010, but in recent years we've seen an uptick, particularly in the Sahel area, but also, of course, Lake Chad basin. And not surprisingly, of course, beyond kind of the toll that this exacts on and the suffering that this exacts on the people directly impacted on conflict, what our chapter brings out is kind of how much of an effect this is having on economic variables. Also, you know, human development outcomes are deteriorating quite rapidly in terms of infant mortality, maternal mortality rates and the like in those parts that are affected by conflict. And, importantly for the work that we do with governments, you know, it's putting quite a lot of pressure on the fiscal accounts. So spending is having to be diverted away from health, education, infrastructure often to military type security spending. I'll give you an example of Mali. In 2012, they used to spend about 2% of GDP on security spending. They're now spending about 4% of GDP. So security-related spending has doubled over the last 5-6 years. And of course, unless they find more tax revenues to pay for this, it's going to have to be financed by debt type, by debt. So it's very real and tangible pressure that this is having. So we draw attention to this, and that these countries really need quite a lot of support to address the challenges that they're facing, and also, of course, failure to address this head-on will have significant ramifications on development.
All right, let me bring it Bismarck in here.
I think the question of conflict, there's ideological conflict, there's also resource conflict. recently we've seen Zamfara State in Nigeria and the mining thing, which goes across the borders with Benin Republic, Nigeria, and all of that, similar to what we had in Sierra Leone, Liberia in the past. And so the mineral type conflict, then oil conflict in the Niger Delta, the ideological conflict in the Boko Haram across the Maghreb. And some of this conflict has a lot to do with poverty, has a lot of economic mismanagement. So the policy that will allow for rapid growth, policies that will allow for equitable distribution of income so that people don't feel left behind, right, will also go a long way to prevent some of the conflicts that you have and help the government address with a kind of Marshall Plan way of investing in taking care of the conflict, displaced persons and all of that in the northeast of Nigeria, across Mali, Burkina Faso. Ivory Coast is another country that's having elections coming, and Gbagbo is back. So we must understand that difference between resource-driven conflict, ideological conflict, and conflict as a result of economic insecurity because of bad policies. All of this have to be put together. So the African leader and African policymaker has its work cut out for it to deal with these issues.
Andrew, very quickly.
Well, I just want to commend the IMF for bringing this issue up. I mean, as economists, sometimes people are reluctant to enter into this issue, but to put it so squarely and all the challenges that Bismarck and Abebe highlight, it's critical for us. It needs to be at the top of the agenda.
All right, then. So let's go to the topic I've actually been waiting to get on to, is the AfCFTA. We've seen all that has been happening, how from when it started, when it was being conceptualized. Now we're seeing the first baby steps coming on board. When you look at this, how do you think the potential this has for the continent?
I think, as my friend Vera Songwe says, this can be a game changer for the region. First of all, kind of is the political commitment that leaders in Africa have put in, and the record time in which they've moved to make it concrete. I think really is remarkable that in a year and a half or so since this was initiated, we now have the affirmation by 22 countries, which is what is needed for this to come into effect. So I think that political signal, that political move shows that the commitment behind it. So that's fantastic. Second is the economic benefits that it can bring about. So we delve into that in our chapter. And what we find is, indeed, even within existing regional economic communities that we have, lowering of tariff barriers has been quite significant, and that has had a salutary effect, a very positive effect in facilitating trade within those regional economic communities. What we are now looking to do is create, of course, a continent-wide community, and we think that, provided the tariffs are lowered as envisaged, eliminated as envisaged, and non-tariff barriers are also tackled, it should boost trade quite significantly within the region. But I'm more excited about the non-linearities that are likely to be unleashed. I'll give you one example. When African countries trade with each other, the trade tends to be mainly in more processed goods, in more manufactured type goods, whereas when we trade with the rest of the world, it's mainly in commodities. We don't trade commodities with each other, with the rest of the world. So lowering the tariff and non-tariff barriers will facilitate diversification in many cases. To be even more concrete, when Uganda exports goods to Rwanda, DRC, South Sudan, it's exporting building materials, processed foods, cement, bottled water, and beverages and the like. When it's trading with China or India, it's exporting tea or coffee and other natural resources. So that's the kind of opening that the AfCFTA will create for countries in the region.
But for countries that are sitting this out, I'm just keeping that wait and see approach. What can you say to encourage them to jump on the bandwagon?
Well, exactly this point. I think you're speaking of Nigeria, one of the countries that's still examining the potential consequences and looking at it closely. I think, first of all, of course, it's legitimate that trade can cause dislocation. It can affect some industries, workers, of course, in those industries. So it's important to try and mitigate any effect that would have, but you can use social protection, etc. So reflection is important, and we've seen trade having very tangible consequences. But it's not just trade that causes dislocation. There are other things that can cause dislocation. Technology, of course, is one. So I want first to say, to assure that the potential adverse effects that trade liberalization can be addressed through specific policies. But second, I don't know the Nigerian economy as well as Bismarck or Andrew, of course, but it strikes me that given how dynamic, given the dynamism in Nigeria, given how competitive the market is, I don't know how Nigeria can fear the rest of the world. I mean, super eagles are never afraid to go out and play with the other countries in the region, right? So,
all right, let me hear Bismarck, because some concerns have been raised.
A couple of things are happening. Especially in Nigeria, involuntary change is always more impactful than voluntary change. So I see it in three contexts. One, the African Open Skies Agreement for airlines, right? There are at least almost 30 flights between Lagos and Accra every week now. It used to be. Now, across West Africa, Open Skies Agreement across Africa. So you have Kenya Airways, you have Ethiopia Airlines, you have Sky and all that. And these people are not going around as tourists. They're going about because of business. You take cement, Dangote cement, it's all over the continent, right? Now, more important is the fact that when the refineries, the Dangote refineries and the other refinery strategies these days are about hub status. You have Singapore, Rotterdam, Houston. If you are going to have that type of big refineries here, you need pipelines and all that to support the entire region. So whether you sign it or you don't sign it, trade flows and people flows and investment flows are going to intensify across the region. So signing it will just be formalizing what is already happening. And most importantly, exchange control, dismantling exchange controls, because the currency revolution also supports trade. People are not just changing currencies because of currencies, they are changing currencies because of trade and investments. So happening at the same time as all of these three variables: one, the petroleum refining, the cement, and the African Open Skies Agreement, together with the African Free Trade Agreement, will come a dismantling of the currency controls at the same time. So a customs union, more or less, will almost happen, involuntarily, and for the common good, especially of the bigger countries like Nigeria, Angola, South Africa.
Andrew, your thoughts?
Well, to begin with, I totally agree with Abebe that this is a monumental achievement. I mean, the new Pan-Africanism, all credit to the Africa Union and to President Kagame for getting it this far, which is, it's real and incredible in a short time. I think two things. One is, just from a strictly economic viewpoint, Africans will only be prosperous if Africans trade higher value-added products with Africans. So if we want to be prosperous, because we're not going to be able to sell higher value-added products into China with a shrinking population, to Europe with a shrinking population, we can only sell to ourselves largely. So we need to have this sort of agreement. I think the second thing is, sometimes people say we're going to have problems with the provenance of goods that come into Morocco. This makes us stronger. We stand as one block now to be able. You think about the power of the EU as the world's largest economic community. I mean, the reason Brexit's such a problem is now India doesn't want to deal with Britain. They want to deal with the EU, right? So if we can stand as one block, then we're going to be a much better deal in terms of China, in terms of the EU, in terms of the US. But the other part, of course, is this rules of provenance. The VP here has mentioned it. We need technologies like blockchain, which just create more traceability for products. Obviously, it's a problem if a product is stamped, it was made in Benin, but it was made in Rotterdam. So those sort of technologies are going to make it work much, much better for us.
I've been speaking to Abebe Selassie. He's the director for IMF's African Department, Bismarck Rewane, the CEO of Financial Derivatives, and Andrew Nevin, the Chief Economist at PwC Nigeria. And that's it on Beyond Markets, and thank you so much for being a part of the show. Remember, you can watch the show at 5 p.m. West African time daily and have access to all previous episodes of Beyond Markets on our website at cnbcafrica.com. You can also stay engaged with the hashtag Beyond Markets and follow me at Kenneth Igbomor. Do have a wonderful day.